Welcome back to the channel. My name is Steven. I'm a pharmacist and I own 52 units of real estate. So I had a great question in the comments responding to my video where I talked about how I've done my own taxes for 7 years using TurboTax. If you haven't seen it, check it out. But pretty much the question was stating, each of my properties are divided amongst LLCs and I have a holding company that owns all those respective LLCs that then owns the real estate, right? So I own the holding company 100%. Or my trust owns a holding company 100%. The holding company owns 100% each LLC, which then owns my properties 100%. So he was asking, well, are you really protecting yourself from liability if you're using the same business card? So I'm using the business card for my holding company, and because each property is not insulated from each other, and the finances are commingled and not kept separate. So actually, it was a really good question. Like I always thought, because I was using my business banking account for my holding company. So keep in mind, like let's say my 20 unit apartment complex, the money is held in an escrow account through my property manager. So whatever income, whatever expense goes into there, and what's distributed is the profit minus the reserve to my holding company business account, right? So I think that one is insulated and accounted for. For my 26 unit apartment complex, that one has a separate BMO account, because I'm required to have a BMO account in order to have a better interest rate due to auto pay. So that one is, the income expenses are insulated, and if I want to distribute profits, I would then distribute it from that account to my holding company, which is through Chase. And then for my other rentals that I self-manage, all the income, all the expenses come out of my holding company, which then own, the LLCs that own that single family homes. So, for me, I've always, kept it separate in that sense, but, it's a good point. Do I need to keep it each business account, or is it okay, or each LLC has their own business account, and then I found the money, or is it okay to have the holding company, which ultimately owns everything else, function for that? So that's actually a great question. I don't know the answer to. I mean, I could see it both ways. I could see it, it's owned through the parent holding company, but I can see that each individual one needs to have their own account, so that whatever distributions you have, you send it from the child's account into the holding company. So if that's the case, I mean, I don't see how that's wrong, right? It's definitely more conservative, but it just gets a little bit more annoying because now you have multiple accounts. Like for me, I get Zelled a lot of my rent, and it just goes to my holding company account, and I make the expenses go out of there, right? So that's a good point, and that's probably something I need to research more about, because I've been doing that the whole time. So, great question and point there, due time. And then the second part of the question is, basically I talk about how I do my own tax for 2 years, and, he mentioned that he owns real estate, he hires a CPA because he does bonus depreciation, cost segregation, and he uses a short-term rental loophole to deduct losses against active W-2 income, right? And because he doesn't qualify as a real estate professional status yet, but, ultimately he said the CPA makes a lot of mistakes, and he ends up having to double check the work and make sure that they don't make mistakes as well. So, basically to me, to summarize that video, I like to be informed as to what the tax code is. I don't want to completely outsource everything to a CPA. Like for me, I would personally rather do all the taxes myself. Yes, it's annoying, it takes a lot of time, but as you're doing your own taxes, you can read about tax law and tax codes. So to me, it's not me wasting time. I'm actually self-educating myself about the tax code, because in TurboTax, they give very nice explanations about it, and then it gives you they give you links to the actual law code, so you can read the TurboTax interpretation, but then also see the actual link to the thing as well. So that's what I really like about that, and so to me, it's kind of like self-education, and to me, taxes is the basic expense. So you have to know how to deal with that, right? So let me go through each of these situations. So bonus depreciation is super easy on TurboTax. You literally go under depreciation, and let's just say I put in a brand new kitchen on a rental property for $50,000. And literally, I think the default, it's maybe 5 years of bonus depreciation, but there's an option. Do you want to bonus depreciate 100% right now? And you just click yes or no. Or you can say, do you want to do $20,000 now and then depreciate the remaining $30,000 over 5 years? It's super easy, right? In terms of the short-term rental loophole, it's basically taking advantage of material participation. So if you are actively managing a short-term rental, which you typically are, you are always actively managing a short-term rental, you can document, I think it's like 100 hours or 200 hours. And from there, what you're doing is doing that. And as you kind of document your material participation, at that point, you're actively managing this property. And when you're actively managing the property, that's when it's considered active losses to offset your active W-2 income. So when you materially participate, and TurboTax will ask you those questions, right? It's pretty easy. Like, this is the conditions of material participation. And you analyze it, and if you click yes, then that income and passive losses will be, that real estate short-term rental that you're doing it will be considered as active losses, right? Which will offset your active W-2 income. So that's all it is, right? So material participation, once again, material participation is when you materially participate. It's an active business. That real estate's treated actively. So if you have active income from it, it adds to your W-2 income. Or if you have active losses from it, from depreciation and all that, that's when you can offset your W-2 income, right? So that's all it is. That's really easy too. It's literally a yes or no question. And the cost segregation is probably the more complicated one. But, once again, I think there's forums on TurboTax where you can quickly search it. And, or you can search the forums on TurboTax, and I'm sure other people experienced it. Or you can do a quick Google search, or worst case, you can get on the phone, call a TurboTax representative, and figure out how to do the cost segregation analysis, right? Because what the cost seg typically does is let's just say you buy a home for $1 million. Typically, you can cost seg 30% of that year one. So you can write off $300,000 year one, which is a huge fat sum. So I'm sure there's a way to do it, but it would probably just require some research on my end. Whether it's the TurboTax forums or whether I'm talking to a TurboTax representative to do that. So it just might be painful to do one, but once you know how to do it, it's easy for the subsequent ones. So anyways, hopefully that answers your question. Let me know if you have any questions. Please like, comment, subscribe. If you want to join the mentorship program and buy multifamily real estate with some guidance, check out the link down below. I also have a school community as well. Hope to see you next one. Thank you so much.